remember that this is an investment. Either an investment in shares or basically an investment in what? An investment in debt instrument. Yes. So I want us to have a discussion on this financial liabilities before we take a short break, and then we come back to do a question. So if you're done basically with what we have up there, I think we can move and discuss on this. Yes. So financial liability. What is a financial liability? A financial liability, basically, we can say that this is a contractual obligation. This is a contractual obligation to do what? To pay cash. This is a contractual obligation to do what? To pay cash. So here, an entity or basically a company has entered into a contract, and in that contract, the company has an obligation to pay what? To pay cash. Now, generally, financial liabilities, these are the debt instruments which have been issued by the company. So these are the debt instruments issued by who? By the company. The debt instrument, e.g. debentures, e.g. bonds, which have been issued by who? Issued by a company. Issued by who? By a company. So therefore, if you come across a question and you're told company X here, for example, issued debentures, the company X issued bonds. So to this company, this is a financial what? Liability. And therefore, you need to differentiate between financial assets and financial liability. So financial asset is whereby a company will have invested or a company will purchase debentures or what? Both. So if you invest, you purchase both or debentures, to you is an asset. But if a company issue debentures or if a company issue both, to the company is a financial liability. To that company is a financial what? Liability. Because once a company issue both, once a company issue debentures, the company has an obligation to pay cash. Now, which cash will our company be required to pay here? Assuming our company issued both or basically debentures having a life of 3 years. It basically means that this company, over the next 3 years, at the end of each year, our company has to pay interest. Once the 3 years come to an end, the company will have to do what? To redeem those particular debentures or bonds in terms of paying back the principal amount. In terms of paying back the principal amount. So therefore, here you can see our company has entered into a contract, and in that contract, the company has an obligation to do what? To pay cash. Yes. Now, in this case, we have two categories of financial liabilities, but majorly we will discuss on one because that is the one which is very common. So we have a financial liability at fair value through profit or loss. So basically, these ones are not common. I will not even discuss that. But basically, just know we have two categories. And then number two, we have financial liability at amortized cost. These are the common type of what? Of financial liabilities. The common type of financial liabilities which are issued by the company. The financial liabilities at amortized what? At amortized cost. Now, these are basically the debt instruments which are issued by the company, e.g. debentures or bonds, which are supposed to be redeemed after a number of years. In other terms, you can say that these are the debt instruments which are issued by the company. They have a fixed rate. A fixed rate means, for example, you can be told a company issued debentures or basically bonds having a life of 3 years. Having a life of 3 years means that those debentures or those bonds can only be redeemed by the company at the end of the 3rd year. Can only be redeemed by the company at the end of what? The 3rd year. They have a fixed life. They have a fixed what? Right. So therefore, that's why we are saying that these are the common type of what? These are the common type of financial liabilities, which are basically issued by what? By the company. Now, what you then need to know, as far as these financial liabilities are concerned, are two things. The amount for initial recognition, how do we determine the amount for initial recognition, and how we determine the amount for subsequent measurement. How do we determine the amount for initial recognition, and basically the amount for subsequent measurement. So when we talk about the amount for subsequent measurement, we are referring to the amount at which these financial liabilities will be recorded in the company's statement of financial position at the end of each year. Now, the amount for initial recognition, or once the company issued this debt instrument having a fixed value, they are initially recorded in the company's books of account at what? The fair value of purchase consideration. The fair value of purchase consideration received. The fair value of purchase consideration received. How much amount was received by the company? Fair value of purchase consideration received minus any transaction cost. Minus any transaction cost. Like in this case, you can be told a company issued debentures, and those debentures which were issued, they were issued, or the company issued them at an amount of 200 million. So 200 million, the company issued shillings 200 million debentures, but during the issue, the company incurred a transaction cost of maybe 2 million. This is the transaction cost which was incurred by the company. So the amount for initial recognition will be equal to the fair value of purchase consideration received. The amount the company received is 200 million. We minus the transaction cost. The transaction cost is the cost incurred in the year issue, which is 2 million. So the amount for initial recognition, therefore, will be 198 million. So the purchase consideration received minus any transaction cost. Then, what about the amount for subsequent measurement? The amount for subsequent measurement, this one is equal to the amortized cost. This one is equal to the amortized cost. Now, for us to be able to determine this amortized cost, we must prepare something called the amortization schedule. We must prepare something called the amortization what? Schedule. The amortization what? Schedule, similar to what we have done here, although we will be able to see there is a slight difference because what we are dealing with here is a financial liability. What we have dealt with in the other question was a financial asset. We will be able to see there is a slight difference in terms of how we prepare the amortization schedule in case of a financial asset and also in case of a financial liability. So I want us to do a question on this once we come back after a short break. There was a question which was examined on this in this sitting, the sitting of April of 2025. If you go to those papers for FR, the papers for FR. Let me share those papers in the class WhatsApp group. So we have this question here, April of 2025. And this was specifically question number 4B. Question 4B. So this is from your papers for FRA. So I want us to take a short break of how many minutes? We can just take a short break of just 5 minutes. 5 minutes. We come back. Make sure you have that question with you. The question for April 2025. April 2025 question 4B. So let's come back after the short break of 5 minutes and then we look on that question. Yes, so I want us to proceed. Let's proceed. Let's continue so that we wind up with this particular question here. A small one, but you'll also be able to see that it involves some workings here. So what have we told? I hope you have that question with you. Abdin Asil, do you have that question with you? Jeffa, Stephen, do you have that question with you? Do you have that question with you? Ridian, are you there? Okay. So what have we told here? A small question, question number 4B. It reads, on 1st January 2021, Trades Limited issued shillings 20 million. 8% raw notes at a discount of 5%. The issue cost amounted to shillings 1 million. Then in paragraph 2, you're told the raw notes were redeemable on 31st of December 2024 at a premium of 1,130,000. The effective interest rate will be, or therefore, is 12.5%. So we are told with suitable calculations illustrate the accounting treatment of the above transaction from 1st January 2021 to 31st of December 2024 in the financial statement of Trade Limited in accordance with IFRS 9 financial instrument recognition and measurement. Round your answers to the nearest 1,000 to the nearest one, what? 1,000. So we are told this company, first of all, which is called Trades Limited, issued shillings 20 million, 8% roll notes. So we have said if a company issued debt instrument, roll notes and debt instrument, basically this is a financial liability. And actually you have said that because they have a fixed rate, because you can see that these roll notes will be redeemed on 31st of December 2024. So these are debt instruments issued by the company. They have a fixed rate. So basically, what that means is that these are financial liabilities at amortized cost. So we can say these roll notes. This is basically for your revision is not required by the examiner. Here we can say these roll notes issued by who? Issued by Trades Limited is what? Is a financial liability at what? At amortized cost. Is a financial liability at amortized cost. Now, having known that, we need to proceed and basically we determine amount for initial recognition. Amount for initial what? For initial recognition. Remember, in this case, were issued on which date? They were issued on 1st January 2021. 1st January 2021. 1st January 2021. Now, for us to be able to determine this, you must remember the formula which I've given you. And we have said that the amount for initial recognition is equal to the fair value of the purchase consideration, the fair value of purchase consideration which was received minus any transaction cost, minus any transaction cost, minus any transaction cost. How much amount was received, and then to that we less the transaction cost. Are we given this information? Yes. Let's go back to paragraph 1, and basically we're told that on 1st January 2021, this company issued shillings 20 million. This 20 million is the nominal or the par value, 8% loan note at a discount of 5%. At a discount of 5%. In this case, you can see the loan notes issued, they had a face value of 20 million, but were they issued at 20 million? No, we are told they were issued at a discount of 5%. So therefore, the amount received, the purchase consideration received by our company here, this one will be equal to 95% of 20 million. 95% of 20 million, because they were issued at a discount of 5%. This is the fair value of purchase consideration received. And then to this, we minus the transaction cost. Do we have transaction cost incurred by our company here? Yes. We are told in the first paragraph, the last sentence, the issue cost amounted to 1 million. There was an issue cost. The issue cost is the transaction cost, which is basically what? 1 million. And I think what we need to do, equally, if you check on the requirement, we are told to work with our figures to the nearest 1,000 of shillings. So just like what you have done in the other question, we will work with all our figures in 1,000 of shillings. We omit the last 3 zeros. Yes. So we take 95% of this, and then we minus the transaction cost. We minus the transaction cost. This will give us what? 95% times 20 minus 1,000, and that will give us what? That will give us 18 million. That will give us what? 18 million. This is basically the amount for initial recognition. In this case, equally, you may show the accounting entry. So this amount, how was it supposed to be accounted for by our company? So in this case, our company received the money. So the amount, this is the money which was received by the company after issuing roll notes. So the company debited that in the bank. The amount was debited in the bank and then credited in a liability account called the financial liability at amortized cost. This is basically a liability account which was credited with the amount which was received. Having determined the amount for initial recognition, we need to move and basically determine the amount for subsequent measurement. For subsequent what? Measurement. Remember, this amount for subsequent measurement is basically the amount at which these financial liabilities or the amount at which these roll notes will be recorded or was supposed to be recorded in the company's statement of financial position, I think over the period of 4 years. So this, if you can be able to recall, we have said the amount for subsequent measurement is always equal to the amortized cost. Is always equal to the amortized what? Cost. And actually, we have said that these amortized costs we'll have, or actually we're going to determine this amortized cost by basically preparing something called the amortization schedule. So that is basically what I want us to prepare. We prepare the amortization schedule, So we need to determine the life of these row notes. In paragraph 2, I think, in paragraph 2 of our question, we are told the row notes were redeemable on 31st of December 2024. They were supposed to be redeemed in on 31st of December 2024. Remember the date they were issued. They were issued on that date. They will be having a life for how many years? 2021, 2022, 2023, 2024. They have life for 4 years. So we need to prepare the amortization schedule for those 4 years. We will have, therefore, a column for years. Basically, the first year will end 31st of December 2021. The other 31st of December 2022. The other 31st of December 2023. And 31st of December 2024, like that. Then our next column here will be for the amortized cost at the start of the year, the AC at the start, and remember all our figures are in thousands of shillings. The next column here will be for the interest, but basically here, this is an interest expense. If you can recall the other question, for financial asset, we had interest income. So once the company invests, the company receives or should recognize interest income. But once a company has issued loan note, the company should recognize interest expense. Now, this one will be computed equally using the effective interest rate. Have we given the effective interest rate in our question? Yes. In the last paragraph, we are given the effective interest rate. In the last paragraph, the last sentence, which is basically 12.5%. Then we have the next column here. Will it be for the cash received? No. Our company has issued loan notes. So our company will be paying some cash. And actually, to compute this one, just like what you have done in the other question, we will take the coupon interest rate. We multiply that with the face, or basically with the nominal value of this loan note. I hope you can be able to remember the nominal value. Who can tell us the nominal value for this loan note which were issued? Jeffa, Felix, Stephen, Lillian, what is the nominal value for this loan note? It's similar to the other question. Similar to the other question which you have done for the financial asset, yes. So this is basically the face or the par value. The face, the nominal, or the par value. So this will be equal to the coupon interest rate times 20. And then finally here, we have the column for the amortized cost at the end of the year. That is basically balance carried down. And also remember all our figures here are in thousands of shillings, like that. All figures are in thousands of shillings. So you can see there is not much difference. So the only difference is that in case of a financial liability, here we have interest income. In case of financial asset, here we have interest income. In case of financial liability, here we are having cash paid. In case of financial asset, we are having cash receipt. That is the only difference. Sawasa? Yes, that is the only difference. So what do we start with here? We start with the amortized cost at the start. Just like the other question, this is the amortized cost at the start, which is basically what? 18,000. So then we compute interest, which will be 12.5% of that. So let's get that one. 12.5% of 18. And that will give us what? That will give us 2250. The cash to be received, I've said we take the coupon interest rate. The coupon interest rate is what we have in paragraph 1. Coupon interest rate in paragraph 1 is given as what? Is given as 8%. So this one will be 8% of the face value. The face value is this one, 20. 20. And basically this will give us what? That will give us what? That will give us what? Yes, that will give us 1600. So this is 1600. And basically, just like what you have done in the other question, to determine the amortized cost at the end, we will take this plus this minus that. The same with what you have done in the other question. So what do we get? We're getting 18 what? Is it 18,650? Yes. So that now would be the opening balance here. 18,650, we get 12.5% of that. So you're getting what? Yes, to the nearest whole number, 23, 31. This remain the same. Minus 1,600. And basically, what are you getting here? 19,381. So this plus this minus that. That's what you're getting? 19,381. Yes. So that will be the opening balance here. 19,381. So we compute interest being 12.5% of this. So which will give us 24, 23. 24, 23. So these remain the same. 19,381 minus 1,600. And that will give us 204. Yes, 2204. Is that what you're getting? And basically that will be the opening balance here, 2204. Yes. So we get the interest, which will be 12.5% of that. And that is 25. Now, at the end of year 4 here, they will be redeemed. They'll be redeemed. So the amount to be received here, will be equal to the coupon payment, this one, the coupon payment over 1,600 plus the capital repayment. So what are we told in relation to the redemption? Let's go back to our question here, specifically paragraph 2. Paragraph 2. We are told in paragraph 2, the loan notes will be redeemed at the end of 2024 at a premium of 1,130,000. So the amount to be paid here will be equal to the nominal value, this one, plus a premium of 1130, plus a premium of 1130. Is there any difference with the other question which you have done? No much difference. No much difference, because even in the other question we had a premium. We have taken the nominal plus what? Plus the premium. The amount to be paid here, therefore, will be 16, this one, the coupon payment plus the capital repayment. And basically this will give us 22,730. So once we compute this one, basically that one should be 0. Should be what? Should be 0. Sasa? Yes, yes. Now, having that, we now need to prepare the financial statement extract. The financial statement extract. And we will start by preparing the statement of a profit or loss extract. The statement of profit or loss extract. Basically, we show what was supposed to be recognized here over the period of 4 years. 31st of December 2021, 31st of December 2022, 31st of December 2023, 31st of December 2024. And basically, our figures here are in thousand of what? Of shillings. So basically, I've said what our company was supposed to recognize here is this one. And you can see this is an expense. So this interest expense was supposed to be recognized here as what? As an expense. Other expenses, our company was supposed to recognize interest expense. And this interest expense, in other terms, we can also refer to this as a finance cost. The finance cost for the first year is 2250. For year 2 is 2331. And basically for year 3 is 2423. And finally is 25. So this is what was supposed to be recognized in the statement of profit or loss as an expense. Finally, we prepare what? The statement of financial position. Statement of financial position, still extract. Statement of financial position extract. And remember, we have said that these loan notes which were issued by our company, these are liability. This is what? A liability. So basically, remember you need to prepare these for 4 years. For 4 years. 4 years here. 4 years like that. And also we need to indicate that our figures are in thousands of shillings. Yes, now this Financial liability at amortized cost to the company is a liability, actually a non-current liability. A non-current what? Liability. So under the non-current liabilities, our company here was supposed to recognize something called the financial liability. The financial liability at amortized cost. Financial liability at amortized cost. And actually, this one will be recognized here as this amortized cost. The amortized cost at the end of year 1 is this one, 18,650. Year 2 is 19,381. Year 3 is 20,204. And basically at the end of year 4 is what? Is 0. Is what? Is 0. So basically this, what now the examiner is requiring, this financial statement extract. This financial statement extract. And basically by doing that, you get how many marks? You get 8 marks. You get 8 what? 8 marks. You get 8 marks. So that's basically how we account for these financial liabilities. That's how we account for the financial what? Liabilities. So therefore, these are some of the questions we are likely to come across as far as that topic of financial instrumental are concerned. I hope you can see there was a question coming from this topic on compound financial instrument, a question we did in our previous class. You also likely to come across a question on financial assets, what we did at the start of this session, and also you're likely to come across a question in relation to the financial liability. So what you just need to do, can you try to redo those particular questions again on your own, and you try to identify the difference between financial assets and basically financial what? Financial liabilities. But basically now that brings us to the end of that topic on financial instrument. It basically means that once we meet now in our next class, which will be next week, basically we are moving to a different topic. We will move to a new what? To a new topic. So therefore, for today, I think we will stop at that point because I know you have another class from 4. I want you to have just a short break before the next class starts. So any question before we wind up? Is there any question before we wind up? Any question before we wind up? Any question before we wind up? I think there is none. So let's stop at that point. Have a nice weekend. See you next week on Tuesday as we move to another topic.